Hi traders, welcome back to the Forex Geek channel. If you're new here, make sure to hit that subscribe button and click the bell icon so you never miss out on tips to level up your trading game. Now, in this video, we are going to be diving into one of the most powerful trading strategies used by banks and institutional traders. We're going to be talking about how to trade like the banks using supply and demand price action. So if you are a beginner, stick around because this video is going to be your guide to unlocking the secrets behind institutional trading. Let us start with the basics, okay? What is supply and demand price action? Simply put, it is the natural force that drives price movements in the market. Just like how supply and demand control prices in any economy, the same happens in Forex stocks and commodities. When demand exceeds supply, prices go up, and when supply exceeds demand, prices drop. Now, banks and large institutional traders know how to identify these zones where price is most likely to reverse. These are the key levels where the market has previously seen strong buying or selling pressure. So, by spotting these supply and demand zones, you can align your trades with what the big players are doing. So, how do banks and institutional traders use this to their advantage? Let us break it down. The big players don't buy and sell just anywhere on the chart, okay? They target specific areas where the price has previously shown a strong reaction. All right? They actually target, specific areas where the price has previously shown a strong reaction. Think about it like this. If price drops to a level where, you know, where there has been a lot of buying before, if price drops to a level where there has been a lot of buying before, there is a good chance it will do the same again. This is where they step in, knowing that this level represents a high demand area. On the flip side, when the market hits an area of excess supply, you'll often see price reverse down because sellers are ready to push the price lower. Now, banks use these zones to enter trades with more confidence and a higher probability of success. And the best part, these zones work on every time frame, whether you are trading on the 1 minute chart or the daily chart, okay? Now, how can you spot these zones yourself? It's all about looking for areas where price has either made a sharp move up or down, leaving what we call an imbalance. This is where price leaves behind a big gap between the open and the close of a candle. These imbalances signal strong areas of demand or supply. All right? Because there was a lot of action in that zone. So here's how you identify a demand zone. Just look for a sharp move to the upside, followed by a small consolidation. Okay? Look for a sharp move to the upside, right? Followed by a small consolidation, right? Then another strong move. So the consolidation zone is okay. So this is for a reversal pattern, right? This is going to be a strong move up, then a consolidation, then a strong move to the downside. Okay, this is for a reversal, but there could be a scenario where you would have a breakout to the upside. So this is going to be a supply zone. Sorry, this is going to be for a supply zone. All right, this is going to be for a supply zone. But let's look for an example of a demand zone, right? Okay, you might find where you have a sharp move to the upside, and then you could still see a period of consolidation and then a sharp move again, to the upside, signaling a continuation. So it means that there was still significant demand around this zone, despite the consolidation. That was just probably an accumulation phase. Okay, so for supply zones, you're going to be looking for the opposite, a sharp drop followed by consolidation and then another move to the downside. Now these zones are where sellers are in control, and you want to keep an eye on them for potential reversals or continuation moves. Now that you know how to spot supply and demand zones, how do you use them to actually trade? First of all, always make sure you are looking at the larger trend. Supply and demand zones work best when you are trading with the trend. If the trend is up, focus on demand zones. All right. If the trend is down, look for supply zones. Okay. It doesn't mean that you can't trade reversals, but if you want to trade in the direction of the trend, then you should be looking for demand zones on uptrend and supply zones in a downtrend. Right. So, for example, if price hits a demand zone in an uptrend and you see a strong bullish candle closing above the zone, that's your signal to enter. On the flip side, if price hits a supply zone in a downtrend, and you get a bearish candle rejection, that's a signal to look for short opportunities. So for all the beginners out there, here's a quick tip. Don't try to trade every supply and demand zone that you see. Some zones are stronger than others. The bigger the move, the stronger the zone. Also, always be patient, okay? Wait for price to actually test the zone and show you signs of a reversal before pulling the trigger. If you are unsure, start with a demo account and practice identifying these zones. Over time, you will develop an instinct for where the big players are likely to step in. And remember, trading like the banks is not about chasing price. It's actually about being strategic and waiting for the right moment. Okay, and do not forget about risk management as well. Ensure you always observe good risk management. Do not trade with an amount you cannot afford to lose, and do not risk more than 1 to 2% of your account balance in a single trade. Okay, so if you found this video helpful, don't forget to smash that like button and subscribe to the channel for more tips on how to trade like the pros. Drop a comment below if you have any questions or if you'd like me to cover any other topics in future videos. Thank you for watching, and as always, happy trading.